liquidity sweep right there. I mean, this was crazy good. I mean, you can see how bearish the book is. Okay, so you see how bearish the book is? Well, do you see how you get these flat levels on the book? That's because nothing's happening. It's a stop run, right? That's just the book almost effectively vanishing at that stage. So when you see that stop run there, you know that's just a liquidity sweep at that point. It's going to just come straight back down and it's going to sell off big style. So you see these stop runs. You can recognize these types of stop runs into these little key liquidity levels, and you can kind of spot them. They kind of stand out. They kind of have these flat bottom edges or flat top edges. You can always spot a stop run when you see this type of thing happening here. Flat bottom edge, flat bottom edge. So somebody's just pulling away liquidity here, and it's running those beautiful downside sweeps. So when you see that sell side book and you see this top edge stop, it's time to get busy. Now, if we look at the beginning of the day into this storyline, you can see that since the beginning of the day, this has been sell side also. You know, I can't zoom in any further on this chart. It's as far as it goes, but you can see that we had another top line liquidity there for that sell coming in as well at that point. You could even argue that there was a top line sell there, which didn't develop, it didn't mature into anything particularly of interest. So when you do the cash open, you can obviously see that the cash open itself, if I take you along to the cash open, you can see there was nothing really of any interest here. Seems fair, seems fair, seems fair, seems fair. And the only place it started to get unfair was here. You can see that this bottom edge became bid. And when the bottom edge became bid, of course, that's when the first upside move started to really pop. But you can see very quickly we lost all of that structural narrative. And then all of a sudden we've went back into that big short at the top edges here, big short at the top edges there. And from that point onwards, there's really been nowhere to turn in terms of getting that book liquidity back into us as a buyer. So you can see at the moment, buyers coming in here, book stays sell side, stops come in and we get a sweep. And then again, that divergence creeping back into the same top edge again there for that S&P to sell back off of that price point. So that there kind of lines up with what we've got here as well on the NASDAQ. And two different kinds of charts. There's a 25 delta chart. The other one's a 1 minute chart as well. So proxies. What is a proxy? When you're doing research work, what is a proxy? It's effectively a stand-in, isn't it? The idea of what a proxy is something that stands in for your research. When you're doing research, for example, anybody that's ever done a PhD, in terms of trading, they might be talking about HFTs and the like, but unless they've actually got an HFT to study, they don't have anything. They've got no HFTs to study unless they've got one from one of the banks to study itself. No bank's going to do that unless it's an HFT that's now no longer in existence. But even then, they probably won't do it because they show a framework for their HFT modeling. So what the researchers have to do during these studies and what the bank researchers have to do is they have to have proxies for certain things. When we draw a value line on the charts, it's a proxy. You probably know this and you probably understand this, but if you don't, it's worthwhile mentioning it. When you draw in, for example, the oil line, this is a proxy. So what is this oil line a proxy for? Well, we already know what this oil line's a proxy for. This oil line here is a proxy for the swap dealers. We know this line isn't the swap dealers. We can all agree that this line is not the swap dealers. But what we were able to establish in the classroom a while ago was that this line very clearly on a big macro chart basis represents the same positioning that swap dealers have on the COT. So therefore, we're able to then use this as a proxy on the very short-term charts for what the oil swap dealers are doing. This is the swap dealers proxy line. Nobody in here has ever said that this is the swap dealers, but it's a very good proxy for the swap dealers, because this is one of the spreads that the swap dealers do all the time in the physical marketplace. So when the swap dealers are selling oil, we want it, selling contracts rather than doing it in reverse, then we want to be selling oil. When swap dealers are starting to buy oil, we want to buy oil. When swap dealers are starting to sell oil, we want to sell oil. When the swap dealers are still selling oil, we want to sell oil. When that ties in with other things, we've got some crazy, crazy good trade outcomes, crazy good trade opportunities, the swap dealers. That's why when we build models, we call them things that perhaps they're not, because we use proxies always. When we build a VTOL line, it doesn't mean that this is what VTOL is trading. This is what we know about the VTOL trade narrative. When we build inflation, we're not buying and selling inflation. We're not saying that's what inflation is doing. What we're saying is it's a proxy for inflation. It has that quality that it has an ability to replicate what we believe to be a very strong proxy for inflation. And therefore, it has a real relevance to our trading. The use of proxies extends further. We had a chat about proxies this morning in classroom about, how much algorithmic activity exists in the world of the market making book. And this is the answers here. On the inside bid and offer spread, about 70% of all liquidity on the NASDAQ and the S&P is algorithmic market making. Okay, 70% of every trade you see, 70% on every inside bid offer spread is market making by the HFTs. Go out another point and it goes up to 77%. Go out by 3 points and all of a sudden you've reached 80% of all volume is an HFT trade. 80% of every single book, limit, bid, and limit offer, you can see is now algorithmic. It's not a human that's making an offer, it's a computer. And this extends out to about 5 price points. Beyond 5, it becomes pretty pointless. Why? Well, because the algorithms are no longer really interested. They're not going to get filled beyond 5. They're not going to get filled beyond 5. Is that news for anybody? I don't think it is, but it might be news for you if you've not come across this before. But basically, when you're building a proxy for HFT activity, the proxy we build is out to 5 prices. Okay, so we go 1, 2, 3, 4, 5 prices out. And generally, as a rule, I go between 1 and 5 or 0 and 5. It doesn't make a lot of difference in terms of individual candles. So when I see that proxy, this is a real proxy. This is a real established HFT proxy. There's been multiple research papers, literally dozens of research papers that have used this as a proxy for HFT activity. Do you understand? This is very, very, very powerful. Now, one of the things you'll probably understand is that a lot of HFT proxies are used by people like governments, the government regulators, for example. So when the government regulators look at HFTs, the question that the government regulators ask is, how can we sense what's actually happening in the world of HFTs? Have we got a way of being able to look at the HFT world and define exactly what the HFTs are doing, and therefore we can regulate them better? So one of the key aspects to that is, what did the governments use? Well, a lot of what the governments used were things like the amount of volume divided by the number of orders. That is a proxy that they used for HFTs. The traded volume index is a possible HFT type way of looking at the marketplace. Whereas obviously just simply using book liquidity is, of course, the most accurate HFT. And if we use book liquidity, we're actually looking at the HFT activity on these candles. So when you look at these book activity levels here, and you look at this NASDAQ, for example, here, you'll see just how good that information is as we zoom out of that chart. When you see that this is HFT activity here, and you look across at these liquidity levels and you say, well, that wasn't a sell trade there at that stage. But obviously when the sell comes in, you've now established a trade level. There it is. There's your trade level. You understand how to do that? It's not that difficult. So when we establish a trade level, remember the value comes in. When does the sell come in and when do we establish value? Well, this is where a lot of people make mistakes in terms of relative value trading. If that's what's happening there, right? So that we've got a value line and we've got a price line. And then the price goes up and the value goes up. That's not a trade there just yet. Unless that hits a what we call a guaranteed premium, it's a very difficult to trade that, right? Because we don't know when the selling's going to come in. So the best thing you can do is obviously wait to see what happens. What if this now turns down here in terms of value? Can I now sell this? No. Because I still haven't seen any selling coming in. So when I see some selling coming in, that now establishes where I have value, where I have a real premium. So now if the price were to trade into this area, I'd be able to use that real premium to sell into. Does everybody understand that? Is that crystal clear? So when we're looking at these HFTs, that move above liquidity there, that's not the trade because we haven't seen any selling coming in yet. With the value dropping like this, we need to see selling coming in from these high prices before we know there's selling coming in from that high price. When the selling comes in, I've now established my sell price. There it is. Now that I've established my sell price, all I have to do now is lean against that sell price. So my sell trade would be here, my sell trade would be here, my sell trade would be there, and my sell trade would be here. That would be my 3 sell trades. You've got to establish a seller. If you don't establish a seller, you're guessing where the seller is. Do you understand that? That is massive for somebody using relative value. If you don't know where that seller is, what are you gambling on? Wait for somebody to show you where the sell is. Wait for the market maker to take the market bid and then look to deal off of that liquidity. These algorithms are incredibly powerful. You know, you can recognize the algorithm at the bottom edge here on oil. Very simple algorithm at the bottom edge here. So when that turns up, where's the buy trade? Well, you don't know where the buy trade is. You haven't really seen any buying coming in. You can start looking for wholesale price levels, for example, because you know that that's going to bring in the necessary liquidity. And that's what happened on oil. We hit a wholesale price level at $81.50, and that brought in the liquidity that we needed that the market maker was going to use, because you can see the market maker is going to use that liquidity. And that allows you to go long into that bit of business there. Still a bit dangerous, but we've seen some buying coming in off of that price level already. When we see this dropping, and then we see a sell coming in behind the drop, you now know that this is a no-brainer sell trade area. And sure enough, that no-brainer sell trade area there made $600 profit. There are some really easy trades here, guys, if all we do is make sure that we understand what it is we're trying to have a proxy for. If I trade in the bond market, the proxy I'm using is the spread traders. What are they doing? Well, I'm using the price of the knob spread to suggest that the spreaders are going bid. If it's going up, and offered, obviously, if it's going down. But we can also cross that with looking at the limit order book to make sure that the limit order book is going up or going down in line with what we're thinking in terms of these trades. So in other words, everything we do in relative value is a proxy for something. This is not a proxy for HFT activity in terms of, it is a proxy for HFT activity, but it's not HFT activity. It might be, is all we can ever say. We don't know who's suddenly gone bid here and why they've pulled away their offers at that stage. This only tells us that that's what's happened. Our view is that if 80% of all the liquidity on that line, and this line is, of course, made up of, as you know, if we look at the depth of market here, and you look at what we've got here, this line is made up of 0 to 5. Well, I could change that to 1 to 5, and it's not going to make much of a difference. So in other words, we've got that proxy in for the HFTs there. So this is our proxy. So if this is our proxy, we know what's happening, right? If this is our proxy here, we know what this is all about. We know what they're doing here. And if we know what they're doing here, we can look at that proxy and then we can establish, well, if the market maker's proxy is bullish for HFTs, is there any swap dealer proxy that's bullish as well? Yes or no? Did the swap dealers go bullish? Yes or no? Yes. So now we've got two different proxies for two different groups of traders. Two of the most important groups of traders both agreeing that this is a bullish bottom edge on oil. Can we take the buy trade? Damn tootin' right we can take the buy trade. Do you agree? That is a no-brainer buy trade right there. And is it done okay? Sure. Have we got all the clues that we ever wanted to buy into this? Absolutely. There's nothing else we can get that's going to be any better, guys. So we want to make sure we take advantage of it. You could always trade this. You might say, but where's the Heisman trade? Well, 51 would be a Heisman trade, wouldn't it? Remember, the idea is to clear liquidity. So you might say, but the liquidity was up here at 61s. No, 50 is a wholesale price, 50 is liquidity. So therefore, 51 is a Heisman trade. So you could have paid 51 on the way back out. If you paid 51 on the way back out, congratulations. You've had a very, very nice $400 of upside beautifulness. Lining up the limit order book, HFTs, 80% of that limit order book are HFTs. 80% of that yellow line are algorithms. Why is the algorithm suddenly buying into the low price? The algorithm is suddenly buying into the low price because the swap dealers proxy is also bullish. So the algorithms are trying to now accumulate a long position. They're pulling away their offers and they're starting to absorb any selling that comes into this drop. And that is a beautiful bit of business. Just the same way as the top edge sell was a beautiful bit of business. Do you agree? The top edge sell was a beautiful bit of business as well. Sell side amazingness. Top edge into that 56 pullback trade candle. That was a beautiful bit of business as well. Stack these two pieces of information together, and all of a sudden, you've got a winning trade strategy. Sell side oil here, buy side oil here, and that's been worth over $1,000 per contract just on those two swings. Craziness. Figure out what you're trying to find a proxy for, check it, research it, understand it,